Welcome to Insights Over Coffee, the podcast where we cut through the jargon and look at what really drives markets and investing. I'm your host, Sahhar Saleh, and today we're talking about an asset that has captivated humanity for centuries, a metal that's once again stealing headlines: gold. In our previous podcast, we examined how global yield curves were influencing market expectations, but today we shift from paper to metal to unpack the renewed frenzy around gold. Prices are testing record highs, central banks are stockpiling, and retail demand is exploding across Asia. The question everyone's asking: what's really driving gold's comeback, and is this just another speculative wave or the start of a structural shift to how investors think about value and safety? We're joined again by Guner Turkmen, CEO of Lake Geneva Investment Partners, and Peter Mezzomo, head trader of Velocity. And as always, stay tuned until the end of the episode of our segment, Signal or Noise, where we'll debate whether gold's latest breakout marks a new era or just another glittery illusion. Now, before we begin, a quick disclaimer: this podcast is for informational purposes only. Nothing here should be taken as financial or investment advice. Please consult a licensed financial advisor before making any trading or investment decisions. So, gold has broken record high this year, but what's really driving this rally beneath the surface?
Well, I guess there's a lot of reasons leading up to the increase in prices of gold, the increase of prices this year and the previous years before that. I think we need to look at a little bit of short-term history at least. I think the big differentiator came with the inception of the Russia-Ukraine war. When Russian assets were seized by US and European governments and central banks, basically it sent a message to the world. It kind of said, your assets are safe with us as long as we get along. And that started back then a move of central banks to start to increase their gold holdings on the one hand. And on the other hand, it also started a move for these central banks and for these governments to repatriate that gold. So the way governments looked at it was, if they were going to have reserves, they wanted those reserves to maintain their value regardless of the political environment of the moment. And that meant that they would like to have a currency that was not controllable by another government. The Federal Reserve controls the dollar. Any dollar payments, any dollar assets must be held eventually with the Federal Reserve. So there's a final control with a centralized government. Gold has a different characteristic. Gold is gold. It's a metal. You can store it. You can melt it. You can resmelt it. You can file it and spend the dust. So it's an asset like few others that has some kind of intrinsic value. So really the beginning of the increase of the value commenced in most recent history with the Russia-Ukraine war and the seizure of Russian assets. Upon that, China and just many global central banks started to purchase gold, either overtly or covertly, through other government agencies and institutions, etc. So that's one factor. The second factor is what we refer to as inflation. Inflation is a word, but what inflation really means is a devaluation of a currency. So when the price of everything is going up, we refer to that as inflation, but what it really means is that the currency is devaluing against itself. So the value that a currency holds is not the same as what it was before. And in those types of circumstances, real assets like gold tend to preserve that value. So that's a secondary value proposition of gold. And a third value proposition is that because the world is unpredictable and because institutions don't know what's going to happen tomorrow, gold has a malleability. You're able to resmelt it so it doesn't really have an origin. You can't say this gold is coming from here, or this is Chinese gold, this is Iranian gold, this is American gold. Once you resmelt it and you produce a new bar, it's It's a new bar. And that also has a value in it because it means that there's no centralized agency that can control the origin of it. And that creates also a type of value for gold. Maybe for why we've been rallying to this year especially, and why we've reached the levels, which is a much more complicated question. I'll dodge that and pass it on to you, Peter.
So, I mean, the reason for which gold's been rallying non-stop, especially in the last month or so, you probably have a certain amount of frenzy in the retail world where people are actually rushing in to buy gold because someone's hearing gold's going up, silver's going up. So the logical thing to do is to go out there and buy gold, even if they don't actually understand what owning gold means. I mean, gold has kind of had a huge move from 2000 to 4000 in the last year or so. Maybe you could even explain it because for so long gold was forgotten. No one owned gold. Gold was stuck in the trading range, probably between just after was it COVID or the Russian conflict?
It was after the Russian conflict that gold really started to move up.
So yeah, so during COVID, gold spiked, came back down, and sat around there for quite some time. And I think, as Gunnar was mentioning previously, it really was this big war that broke out with Russia and Ukraine, where people started to actually question whether gold is probably a better thing to own than, say, even other currencies. To have something that's kind of universal and is yours and no one can actually take it away.
I guess that there's also been a period where other asset prices, equities, technology in particular, have really outperformed gold for a long period of time. And maybe gold played catch up, especially in the last 2 years. I mean, and just to refresh, we had a high coming into COVID at around close to around the 2000 mark.
Yeah.
And then the market sat there until the second half of 2023, and since the end of 2023 until now, we've more than doubled in the price of gold. So there was a long wait period for about 3 years, and then really we started to see the gold dynamics changing. And I think to your point, Peter, that there's a substantial level of fear of missing out on rallies, which creates an enhanced participation. Maybe especially the recent rally from around 3,400 or so until these levels. Perhaps the driver is less the central banks and the more fundamental buyers of gold, and more the speculative or just equity investors and trying to diversify their risk assets.
It's kind of surprising how much they can make a move, though, isn't it?
Yeah. It's this recent rally is, in terms of money, is very substantial amount of money in a very short period of time. There are liquidity constraints, right? So even though gold has a lot of depth, there's so much physical gold in circulation, so it's not so easy to get your hands on physical gold. It's not so easily convertible in the physical market, and I think when flows are very sudden, you do have a dry up of sellers that can drive these types of price increases. Gold's never really been cornered in its history. It's a very vast asset. We've had spikes in silver going back many years. Back in 1979, the Hunt brothers tried to corner the silver market. It spiked. I think it went from $4 to $50 in a pretty short amount of time, but then went pretty swiftly back almost all the way. And then we had another spike back in 2011 up to the $50 range. Silver is more prone to manipulation and lack of liquidity, just because of its nature in the commodity markets, and the availability of the gold is generally quite liquid. There's also, in the gold markets, you have a lot of discussion about the difference between the physical gold and actually the gold in circulation. So just because there's a lot of derivatives, there's forwards, there's futures, there's ETFs, and there's the ownership position of gold and the short positions by dealers in gold vis-a-vis the physical is always something that's question, and we never really have an answer to it. But nonetheless, when risk asset owners diversify into an asset to protect their positioning in the risk assets, what it unfortunately does is it increases the correlation of that asset to the risk assets. So even though 2 years ago, a year ago, there was very low correlation between gold and, let's say, equities or other risk assets, today that correlation is probably much higher just because we're getting a larger participation by equity holders and risk asset holders into gold. And what that may do is, in the case of a volatility in risk markets and equity markets, that volatility may actually adversely affect the price of gold. So gold may not function as a diversifier when push comes to shove. It remains to be seen. We don't know. It really depends on the percentage of ownership and how much that risk allocation has shifted.
I guess it also depends on liquidity issues, right? To liquidate some of the book for margin calls, if you get really, really big moves in the market, you go towards gold's probably an easy thing to be sold, right? As we've seen probably in the last 10 years, people are constantly buying the dip. No one on earth seems to ever want to sell any tech stock. So, you'll get to a point where tech is the last thing to be liquidated. You'll go through all your gold and your alternatives before having to sell tech, actually. So yeah, going back to what you were saying, gold at 4,000, can it go higher? Probably can. But the problem we have here is that gold has kind of it has stopped acting as a hedge to the markets. Everything seems to really be moving together. You'll get the markets higher, you'll get tech higher, you'll get speculative stocks higher, private credit higher. It all moves together. So we're seeing this now on the upside, and maybe people who are actually buying gold, well, they'll be surprised that when we start seeing downside in some assets, gold will inevitably get hit as well.
Just one very important point is these concerns we have is really geared towards the recent rally that we're seeing in gold, because until then, gold was acting in a pretty much non-correlated way to equities and risk assets. It's this recent, I guess, 3 to 6 month steep rally in gold, which coincides with a rally in the remainder of risk assets. So it's more a short-term concern than a long-term concern, because what happens is when those buyers eventually get flushed out because gold doesn't act the way they were expecting it to, it will resume its fundamental characteristic. So I think gold is a hedge for many things. One, it's a hedge for inflation, because inflation is a devaluation of currency, and gold is always a hedge there. Gold is an asset that's not controlled by any governmental body or by any entity, so it has a value there. But gold is also a hedge to our humanoid nonsense as well. So all the mistakes that we make, at a governmental level or at a central bank level, the answer to all of those lies in real assets like gold. Countries are putting too much liquidity into the system. Gold will be an answer. If the interest rate in a currency is not where it should be, gold will be an answer. Ask any Japanese investor how the gold is doing versus the yen. Right? So even though gold doesn't pay an interest rate, it doesn't have a dividend, create anything, right? It's not like a company that creates value or growth or anything like that. Gold still has a tremendous amount of intrinsic value, and that will always remain there because it's the one thing that we're not able to control.
If gold is reclaiming its monetary role, what does that mean for the future of central bank policy and for assets like Bitcoin that claim to be digital gold?
First of all, I guess that's a big if. So we don't necessarily know whether gold is going back to its heyday as a reserve currency for central banks or not. We do know that if you go back 100 years or 80 years or 60 years, that gold was a much more substantial part of central bank reserves and global reserves than it is now, even though the price of gold has been quite strong over the last few years. What we do know, let's say since the Second World War, there has been a dollarization of global finance and global reserves and global trade. And that's something that started just after the Second World War and has been on the rise until relatively recently. With some of the geopolitical distress that we've had over the last 4 or 5 years, that may be changing, and that may be what's behind central banks increasing their gold reserves, because gold is kind of the global currency, right? Because it comes from the core of the earth. And two, it's an asset of its own. It has value because humankind has decided to attach some value to it. So the big question is whether gold is going to be a leading global reserve currency or not. Answer to which we don't know. And the second is naturally the global economy has grown very substantially. So because of this magnitude of growth, it's very hard to see gold reclaim its previous levels in terms of percentage of global reserves. So we wouldn't expect gold to go back to those previous levels of global reserve just because of the way the world has changed. But we're very, very far away from those highs. So there's a multitude of probabilities and possibilities between where we are now and where those high levels of reserves were.
But in terms of Bitcoin,
I mean, people think it is, right? It's going to behave like gold or as a new currency in the new world.
Yes, I guess that's kind of the moniker that's attached to Bitcoin is that it's potentially digital gold. And that has yet, I guess, to be seen and to be proven. Well, there's an incredible track record of value gains in Bitcoin and some other cryptocurrencies over the last, I guess, 15 years almost now. And that growth and some of the characteristics of cryptocurrencies where they have similar characteristics to gold, where you mine gold and you mine a cryptocurrency, and it's difficult to extract, just like gold is, and it's in limited supply, just like gold is. So it has some of the characteristics of gold, and it has some other characteristics as well that can be more easily transferable from one entity to the next. Very pertinent characteristics there. However, the vote will come from the populace. It's only over decades and time that we'll see whether investors and central banks decide to really make it a part of reserves or not, or whether they tie the mechanism of crypto to the mechanism of real assets like gold or oil.
I mean, the whole idea of it, right, was for it to be out of the system. That's why people started using it, adopting it, mining it. I mean, it is my view is that I struggle to see how the government will ever be able to, let's say, control it or to decide it's a store of value for the world. But I mean, as you say, it'll be down to the people to actually decide if it may be bigger purpose one day in terms of store of value or new currency.
One thing that will probably become pertinent over time is the possibility of crypto adding transferability and convertibility to physical gold. So the more we can attach a physical asset with a mechanism of transacting with that physical asset, the more importance it will gain. So these are all yet to be seen.
last time on our previous podcast episode, we spoke about portfolio diversification. What role gold might play in diversified portfolios going forward?
There's two ways of looking at gold. One of them is to see it as a currency, and the other one is to see it as an asset. If we're to talk about currency, I think this is a subject that's kind of very forgotten in general portfolio considerations, because we generally accept a currency. If we're US based, we'll accept the dollar as our currency. If we're European based, we can accept the euro as our currency. Typically, emerging market countries have their local currency, but also will use an external currency for their investment portfolios. So many emerging market countries will have their private saving in dollars or euros and the such. So that's generally the first consideration that you need to have in a portfolio. What is your base currency? If you're thinking about a base currency, should gold have a consideration? In my opinion, absolutely, it should have a consideration because it's the only currency that's really not tied to the global central banking system. And no matter how much countries have different GDPs, different balance of payments, different central banks, different central banking systems, different types of democracies, or different types of government, they are still somewhat correlated to each other. Interest rates are very often correlated to each other, and the one country's needs to protect the value or to keep a lid on the value of its currency vis-a-vis another is also action-based. Whereas gold is first of all, defenseless. It doesn't have a protector. It doesn't have a keeper. There's nobody trying to put a lid on it. There's nobody trying to put a floor on it. It's a currency of its own. So it's from the perspective of currency, it's a true diversifier to any portfolio. From the viewpoint of an asset, there it also has a value in a portfolio, again, stemming from a correlation factor. When leverage is very high and when growth is low in the deflationary period, gold may not fare well, as perhaps equities may not fare well during that period as well. So gold is not necessarily non-correlated, but from a number of factors, it is non-correlated. It also has a characteristic of being a defensive asset, especially during geopolitical stress and the such. So yes, we do believe that gold has and should play a continuous role in portfolio management.
Thank you both. Before we wrap up, it's time for our tradition here on the show, Signal or Noise. For those tuning in for the first time, here's a quick rundown. I'll share a headline that's been making waves, and our guests will weigh in on whether it's a genuine market signal, something meaningful and lasting, or just noise in the background. But first, a quick disclaimer, everything shared in this segment is for informational purposes only and does not constitute investment advice. For any financial decisions, please consult a licensed financial advisor. So the headline reads, Gold tops $4,000 for the first time, fueled by U.S. shutdown. Is this headline a signal pointing to a deeper structural turn in gold markets, or just noise of temporary spike driven by short-term events?
I'll go out on a limb and say any headline is noise just because it's a headline, because it's catchy. It's very hard, probably impossible, to understand the exact drivers of any market move. We make assumptions on why a market moves in a certain way and what the drivers are, but they're never really the absolute truth. There are many drivers of the gold price going higher that could be stated. However, when you look at the acceleration in the price increase of gold, you see probably a speculative factor to the market participants. The higher the level of speculation, the higher the volatility of an asset at any point in time. And probably there are many drivers, such as gold miners covering shorts in light of a strong market. Shareholders are interesting. Shareholders of gold miners want the gold miners to be very hedged when gold is going down, but they don't want them to be hedged at all when gold is going up, which is an impossible task for any gold miner. But like I said, there's probably many factors, many of them which we don't know, but I don't think the move in gold can be tied to one single particular factor. It's very multifaceted.
I agree with that. The headline, the gold tops 4,000, just happened to happen around the shutdown. I think that's just a coincidence, actually. Not sure it has anything to do with it at all.
Very possibly so.
And that wraps up for today's episode of Insights Over Coffee. I hope this conversation gave you a sharper perspective on gold and how the timeless metal continues to shape market sentiment and portfolio strategy in the modern era. If you enjoyed today's discussion, make sure to follow, subscribe, and share it with anyone curious about the forces redefining global markets and the evolving role of gold within them. We'll be back soon with more conversations on the future of investing. Thanks for tuning in, and until next time.